everybody, Josh Sigurdson, World Alternative Media here, and of course we're joined by author and economic analyst here at WAM, John Sneisen. And while the stock market, a lot of people are saying, well, it might be going back into bullish territory. Well, let's not get a bit too ahead of ourselves here, folks, because we know the fundamentals are not there. We see investor confidence, as we've seen for a long time, but we do not see fundamental value. And we see the remnants of something we've seen so many times before, massive bubbles, over speculation, and we just don't see good innovation there. We're not seeing the kind of innovation that we once saw, and we're seeing a lot of the Federal Reserve pumping up the stock markets with fake money. We see crazy derivatives bubbles around the world. We're talking multi-quadrillion dollar derivative bubbles. It's just unbelievably unsustainable. And while some banks are saying that we're on the right track, like for example, JP Morgan, which as this CNBC article says, is it bear or not? JP Morgan says the market will face a test soon that will give the answer. And I'll just go into the bullet points from the article. It says JP Morgan says the S&P 500 is close to hitting a key resistance level that will determine if this is a bull or bear market. The next confluence of resistance rests at 2,713 to 2,741. We view that zone and other nearby levels as a critical inflection for the rebound and dividing line between bear market mean reversion versus a resumption of the long-term bull cycle, says the bank's technical market strategist Jason Hunter. The S&P 500 rebounded from its worst December since 1931, posting a more than 5% gain in just 4 weeks of the new year. Ooh, big deal. Well, it's funny because there's like there's a back and forth there, because as we recently reported, Janet Yellen had said that we won't see another financial crisis in her lifetime, and then she kind of went back on that and said, oh, well, maybe we will, and maybe we need to be careful, because a lot of the top elites that we have been talking about so long here at WAM are starting to see, like, there's something not right here, and we're probably going to meet that inevitable end that we've known all along was going to happen. So we better start covering our own butts and saying that, hey, maybe we should watch out and be careful so you don't end up like Ben Bernanke or Paul Krugman saying the exact opposite of what really happened, or John Maynard Keynes saying the exact opposite of what really happened. And with yield curve inverting and all this craziness, let's look at Investopedia, where this article came out recently. It says, why Morgan Stanley says get out of stocks now. And as the article goes into, given that big Wall Street firms are almost perpetually bullish about stocks, Morgan Stanley is raising eyebrows these days by advising investors to head for the exits and do it now. We struggle to see the upside in hanging on just to see how long we can. We think it is better to hop off now and rest up for the next rodeo, says Michael Wilson, the Chief Equity Strategist at Morgan Stanley. Maybe the bull ride since December 24th has not gone a full 8 seconds, but we'd look to dismount anyway. We're close enough, and bulls can be dangerous animals. Regarding this rodeo reference, a complete bull ride lasts for 8 seconds. Wilson, who made his comments in a note to clients quoted by MarketWatch, cited 2 main reasons for his pessimism as outlined in the table below. And it shows EPS growth only 1.3% to 3.5% in first 3 quarters of 2019, GDP hit of $11 billion from partial government shutdown. And of course, this is very, very significant just because, these guys do not go bearish on anything until they kind of have to save their own livelihoods, their own career going forward. They want to be, if they're under like 80, they want to be able to actually continue to advise people after the next crisis. So they got to pretend like they know what they're doing and show people that, hey, maybe you shouldn't go too overboard investing in speculation when there's no fundamental value there. John, what do you think about all this?
Well, I think what it says, it's time to get out of the stock market, because the stock market hasn't really shown its ugly head yet. And from people that believe that we're just gonna take off even higher, they should take a look at this is a chart that shows the S&P stocks that I have up here that shows since 2011, Josh. And what we're seeing here, if you took a look at the chart, you see like some ups and downs. There's some minor downward corrections, but then an up again. But what you see just recently, after it hit that peak in late 2018, you've seen a huge downtrend, and I don't think, like, from what it looks like here, we're most likely in for some kind of crazy ride downwards, because when you go and look at other parts of the economy, you take a look at, for example, the recent number that just came out from about the consumer confidence, which just dropped drastically down for January. This was after the big shopping spree. I guess everybody's in and have maxed out their credit card debts. They're kind of starting to struggle on keeping the spending binge up and running and keeping the stock markets going. Because, of course, Trump and Mnuchin came out. Well, first Mnuchin came out in December, right when the crisis really started to unfold, saying that, everything is fine. There's no liquidity crisis. But the thing is, in the first place, nobody was saying or that there wasn't a liquidity crisis. So was there? That's the biggest question here. Did the banks actually have a liquidity crisis that kind of started in December, and they had to come out and calm the markets by completely blatantly lying, which they had before, of course.
Wait, John, are you saying that banks lie?
No, banks would never lie, Josh. They would always tell you what's right and make sure that your portfolio always grow and make sure that you make money instead of siphoning off about 30-40% of your portfolio over your lifetime. No, they're fine. They make sure that you are taken well care of and that you would have no problem at all, coming up in a crisis at all. And there's nothing, we're going on a run to 29,000. If we are, it's probably on the back of more quantitative easing, more money printing, and it's just utter BS that's going to come out here. What I believe is going to happen, Josh, is we're going to see somewhat of a tug of war between the plunge protection team that is constantly in trying to buy up the market, which is the major banks. It's like JP Morgan, Citibank, Goldman Sachs, Bank of America. All the major banks are in there trying to help put more liquidity, take deposits off the balance sheets that they have with the central bank, and try to push it into the markets to keep the market dream alive for the elites out there, so they can sell off all their assets, get off their push their balance sheets, get rid of whatever they can, and sell it to the sheeps again, because that's what happened in 2008. Is everybody started to buy at the high. Same with the bubble in Bitcoin that was just recent, where you have Bitcoin and alt currencies just ripping up. Everybody was starting to get in right at the top. It's just crazy how psychology works, and how the FOMO that people are just driven to it at the end of it, instead of when they got the advice. So maybe you should take a look at it, because it looks like it might take come on an uptick. No, everybody's just rushing in at the end, when of course the BNNs, the Bloombergs, the financial news is out there pushing that it was just a little buy the dip, get into the markets right now. Meanwhile, PE ratios are still at record highs on a global scale. They're still high, Josh, and that's the insane part here. They're still at a high, but meanwhile, markets in Europe, for example, are down between 12 to 20%, depending on where you are. It's just showing that we are in a deflation, like peak kind of debt level, and that's
of course.
That's what nobody's talking about.
There's no doubt about it, John. And I find it interesting that we talked some months ago about Larry Fink from BlackRock, who at the time was saying that it's time to buy, and he said that right before this massive dip. Interestingly enough, it was kind of that desperation move. And
that had nothing to do with it, Josh. Come on.
And recently, the CNBC article came out that says BlackRock CEO Larry Fink calls a bottom in stocks for now, but warns about geopolitical risks. And then at the same time, I just want to update some people on some of that stuff. He's looking at putting in one of the most aggressive diversity policies at BlackRock, and he's focusing all his attention on making sure that the people that work at BlackRock aren't all white. So as all this crazy stuff is happening, like this article from Fox Business says, BlackRock's Larry Fink rattles employees amid political posturing hearing, and that Larry Fink, the founder and chief executive of BlackRock, recently told the firm's 14,000 employees that he is instituting potentially the most aggressive diversity program in corporate America, ensuring that a bunch of white men will no longer be running the world's largest money management firm. And I just find it interesting where the priorities are. It's always the distraction mechanism, one way or another. Everyone realizes that Larry Fink is wrong in most of the things that he says, so let's distract people by looking real progressive. And it always seems to be the way. It's like the oil companies that are supporting the anti-pollution agendas, and the banks that are supporting the leftist candidates that are speaking out against the banks. It always seems to be this way. They're distraction mechanisms. They're ways to keep people distracted from what's really going on. And if you actually look at the more important subject matters, which are money, which people just don't understand. People do not understand money. They're busy. Instead, interestingly and beneficial to the establishment, they're looking at people like Larry Fink, getting rid of all the white guys at BlackRock. I mean, it's just ridiculous what level these people will go to today to avoid the inevitable fact that we are seeing the end of a cycle. And the cycle has been propped up more than we've ever seen any cycle in history, and has been pushed off from past times where we've seen with the Federal Reserve, with the stock market and the housing market as well, going back to 2008, 2007. We're seeing banks that are bankrupt. The balance sheets prove that, as you've shown, John. I mean, it's just getting to a point where it cannot be sustained anymore, and they are trying to find ways to keep people apathetic, keep people divided, and keep people bowing down and dependent on them. It's kind of pathetic.
Yeah, no, it totally is, Josh. And you were talking about the balance sheet of the Fed, for example. Even though that they sold off, about 1% of their balance sheet, 10% of their balance sheet, the Federal Reserve, but they actually started at $800 billion on their balance sheets. Currently, it's at $4,121 billion. And if you look at the actual increase or decrease in balance sheets, I'm going to look at the major central banks. You're looking at since 2008. You have the Federal Reserve, they increased their balance sheets 415%, which is a quadrupling of the money supply. The ECB did 311%, the Bank of Japan 413, and worst of them all was the Bank of England 460%. But then I'm going to just quickly show you how over the last year, because they're saying, the Fed is in quantitative tightening, they're selling off their balance sheet. Meanwhile, everybody else is racking up on more. The Fed's balance sheet is down 6% over the year. Meanwhile, the ECB's is up 5%, the Bank of Japan is up 5%, and the Bank of England is up 4%. So if you look at that, like compared to their assets, there's actually a way bigger increase. And I looked at the total balance sheets of all the central banks in the world, the major ones anyways. I think it's about 60 or something that I looked at. There's about a 3% increase over just the last year. So where's the tightening in the world? Where are we selling off the assets? No, we're not. They're actually putting in more and buying up more assets, do more quantitative easing around the world. So there's no tightening per se, and all this BS around. We're all good. Everything is fine. Meanwhile, we're hitting peak debt levels. That's what mostly they're not talking about in these articles.
Yeah. And the people that are investing in the stock market, John, I mean, a big part of it is that, there are good companies out there, obviously worth investing in. But with that said, when you're mixed up with a highly volatile, highly dangerous, bubbled up stock market with a whole bunch of mostly terrible ideas, then what happens then? I mean, the good companies, they go under too for the time being anyway. When the whole system goes down at the same time, we're going to see a massive domino collapse. So what would you say in your opinion? Obviously, this isn't investment advice, but what would you say in your opinion investors in the stock market, even good companies, investors in the stock market should do right now?
Well, the problem with the big public exchanges, Josh, is that you're stuck in a movement kind of thing if you're investing in only public companies. If you don't have the money that you can invest in the private companies, that a lot of companies have been taken private lately, and they're not on these stock exchanges because off the stock exchanges, you're less, attached to the volatility of all this massive sell and buys that is happening on a worldwide scale. If you, for example, have a collapse in in, the currency, you have a lot of, algorithms that are just going to sell off everything. And then that means even good company will start to get sold off as well. So it's like kind of a bad way to be stuck in those public markets. But that's a problem. Most of people are stuck in their 401ks, their RSPs. They're stuck in those public markets. They don't have, the clout or the actual money to be an accredited investors having over $250,000 to actually be able to invest in the private markets and in actually decent investments. So you're looking at, for example, the guy at Morgan Stanley that I asked, hey, like all this talk about this up and downs, like what is the real problem? Do you think like the real problem is actually debt? It has nothing to do with the trade wars and so on? And well, sure enough, like another Morgan Stanley guy, he tells me, hey, it's I've been writing about this the last year, he said, how these problems are coming up. He's a senior vice president there, and his investment letters are telling his investors that we have a debt problem in the world, and nobody's listening. There's just only these kind of few voices within the banking system that actually are telling the truth, that are good people that actually want to, save their the people that they're trying to invest instead of ripping them off like 95%.
Well, there's a mixture between that, John, and those even Christine Lagarde recently, they're coming out and saying there is a debt problem, and they're only doing it because they know the collapse is coming, so they need to cover their own butts. But then there's a lot of them, these advisors that have been saying this for a long time. But John, like I was kind of getting at there, what do stock market investors do about all this? When they see this coming at them, it's obviously scaring a lot of people.
Yeah, no, first of all, they usually go to bonds. Well, bonds is in trouble because it's a massive debt problem worldwide. So that is not kind of off the table for people looking at the bonds. Well, what is left then? It's left commodities and precious metals. Well, a lot of commodities will get hit and strangled during a crisis because they're consumption based. They need, a good thriving economy. So when the economy tanks, you get a big depression. Most of, oil and other prices will go deeply down because of crises like that. So those are kind of off the table. Well, what is usually there to save investors? Well, you have gold and silver prices. Actually, there was an article that we haven't mentioned in this video that said that the gold hits 8-month highs. So it's on the way up again. It's trying to push. It's past $1,300 now. It's trying to push that 1350, which is usually the manipulated level that they tried to push it down again. If you go and look at the chart of gold over the last 5 years, you'll see that it has a roof around 1350 that'll get pushed down again and sold off. But of course, that's a whole bunch of fake paper. So
and the guys that are spoofing that market and trying to push it down, they're going down themselves. So they're having a hard time keeping up with something like gold and silver.
And the problem, it's like a massive Ponzi scheme. GLD and SLV are over issued paper versus the actual physical metal that's underlying. So it's just a big Ponzi scheme. So you need to hold the real things. I think that's for whoever is going to actually win now during the next crisis needs to hold the real things. And that also comes to cryptocurrencies. With cryptocurrencies, most people today, they don't understand that if you have your money at an exchange, it's like having your money in a bank almost, where you are actually liable. Like you are, very in problem if they get hacked. For example, we saw that with the recent Cryptopia hack in New Zealand. You've seen all this stuff happening where people thought they had control over their currency, like their cryptocurrency. Well, they got stolen. And also, if a crypto exchange has a liquidity crisis, they don't actually have all the money that they told you they had to do all these trades. Well, that's also a problem. That's kind of like a bank saying that, we only have 3% of the depositors in cash. That is kind of what could happen. So you need to hold it privately. That's one of the main reasons,
though. That's one of the main reasons, John, why people need to actually focus on why cryptocurrencies exist, for decentralization, not putting them on an exchange. It's no different really than a bank, and then can lose all their money because it's a centralized exchange. I mean, it kind of defeats the entire purpose of the entire movement towards decentralized cryptocurrencies that have fundamental values. It's a huge issue because a massive amount of people, I would say the majority of people, have their cryptocurrency not in a safe way on an exchange instead of on a hard wallet or something like that, which is very, very detrimental long term.
Yeah, no, and it's the same thing as we were talking about with having like anything, like even your cash should be off the banks. Like it shouldn't be in banks, for example, because it's a huge risk of the banks. Actually, I showed the Canadian banks have, a lot of times between only 5 till 1% of their deposits available in cash. So during a crisis, if you get a debt crisis on top of it, they think that they can liquidate, their treasury holdings, for example. Well, if you get a debt crisis, those treasury holdings are not going to be worth much. So there's only going to be the cash left, and then the cash left is next to nothing. So a bank run is inevitable, and the collapses of banks on a massive scale, where you have the CDIC, the FDIC, all these deposit insurance corporations are going to fail because they don't have the money. The financial claim schemes in Australia doesn't have the money because they only cover, I think it was $50 billion of 600 to $800 billion of deposits. So you're seeing this whole like thing to believe that we trusted in the system. I don't know why we trusted in since 2008. Didn't we learn back then? No, we didn't. So we're
Didn't
actually
we learn
getting
over
hit
1,000 years?
Yeah, we're getting hit over and over and over again. But what's surprising though is that it was only 10 years ago that we had these crises and we lost all this money, and we're not learning. We're continuing to do the same mistake because it's a lack of financial education, and that comes back to the last point that we need to make here, Josh. It's you got to go out and educate yourself about money and economics, and like all the stuff that I'm saying here is my opinion, of course, but it comes out of understanding and looking at different investments, looking at trends, looking at how they performed over time and how there's cycles to them with, when you get these market crises. But now we're actually hitting something even worse, which is an actual monetary crisis, which we haven't really seen since 71 when the US dollar failed. It failed in 33. It failed in 1913 when they created the Fed. So all these, it's another failure of the currency again for the United States, and it's going to happen on a grander scale. I believe we're probably going to see a lot of other currencies fail first, but then we're going to get hit really big in the United States. The last kind of domino will fall, where it's the last kind of trust. You've seen people exit out of the US dollar on a grand scale. Like tons of countries are now trading outside of the US dollar using their own currencies because they don't trust the US dollar anymore. And looking at the markets and everything else, Josh, it's a very dangerous place that we're in.
Yeah, it's a domino effect. Countries are swapping out of the currency across the board, and we have to remember that the same thing that we've talked about all the time here at WEM, all fiat currencies eventually revert to their true value of zero. They always have, they always will, going back to 1024 AD in China, and this time won't be any different. We cannot put a date on it, but we know it's going to happen. And the stock markets too. We've seen this cycle go over and over and over and over again, while people just completely forget the past within 10 years and get back into that same cycle and lose everything. And it's crucial that, as you mentioned, John, people get educated. With education comes responsibility, financial responsibility, the hallmark of freedom itself. That's the only thing that's going to save you, folks, is you being responsible and knowing or understanding money. If you have control over your money and your money doesn't have control over you, you are a free person. But anyway, it's just important that people decentralize everything and try and be as self-sustainable as possible and look to diversify, of course, in our opinion, not investment advice, but, cryptocurrencies and gold and silver. We do have an affiliate. If you're looking into some gold and silver and stuff like that, we do have an affiliate with Mike Maloney, who's one of the greatest. You could check the link below in the comments, pinned to the top of the comments. Mike Maloney's goldsilver.com. Very, very happy to be working in one way or another with him, because he's been crucial in educating people on monetary history and how this cycle happens time and time again, and people keep forgetting because it's boring and it's not interesting to learn about money. But money, understanding it, makes you so much more in control of your own life, which is really important when you see these banks and these governments, two organized crime syndicates that work hand in hand, benefit from your servitude, from your dependence. Do not be dependent, folks. Be independent. Understand this stuff. Protect yourself, protect your purchasing power, and be ready for the worst. and hope for the best, as always. So, John, thank you for going into this with us again, and we'll be back at you guys with much more. There's always lots on the way, and we're coming up on Acapulco, so check those tickets as well in the description. You get
good times.
up to 15% off on your tickets by using promo code WHAM, as we mentioned at the end of every video and in the comments. So make sure to check that out, because that's right around the corner, folks, and we're going to be reporting on tons of stuff in Acapulco, Mexico, with incredible people. Ron Paul, Judge Napolitano, all those people are there. Immortal Technique, the rapper, he's going to be there now. Lots of very interesting people, interesting mixture.
Yeah, hey, and it's going to be warm down there. I can't wait, because now, currently, Josh, we're at minus 50 with the wind chill here, so I can't wait to get down to those plus 30 temperatures down in Acapulco.
Yeah, I'm not minding the 75 Fahrenheit up in or down in Las Vegas, John. So I'm sorry to hear about that. I've seen that. My thoughts are with you guys, but nonetheless, I'm gonna be smiling all the way out to the beach when we get out to Acapulco, where we can interview lots of incredible people and bring you guys the warmth, hopefully, that you're able to unfortunately get wherever you are with this huge cold spell happening. So anyway, stay warm, everyone. Thanks for going into this with us, John. The markets are freezing, and let's do our best to take care of our own wealth and our purchasing power, and do the best we can to protect ourselves long term, because this won't be easy. The end of this system is coming very soon. We just cannot say when, but it's going to be crucial, this bit of time that we have right now, to understand these markets and do whatever we can to protect ourselves and our families going forward. Be responsible, folks. Thanks for going into this with us, John. And until next time, this is Josh Sigurdson and John Sneisen signing out from World Alternative Media. Find the truth,
be the change.
Like what you see here, OM? Don't forget to check the links below. GoFundMe, Patreon. We can't do it without you. Any donation is very much appreciated, especially as we are so vastly demonetized and censored on YouTube, as these guys come in and flag all of our content as hate speech. Also, check out our Bitcoin address below, as well as on the screen for you to scan if you please. And also check us out at steemit.com. We're at Josh Sigurdson. It's a future of social media where you get paid in the upvote of your post in cryptocurrency. Steem, that is. So make sure to check us out there. Make sure to join us at Acapulco 2019 with people like Ron Paul, G. Edward Griffin, of course, Jeff Berwick, Vid Jedlicka. So many incredible speakers are going to be speaking. It's just a massively growing event. It is something you have to see to believe. So make sure to check it out below and save money on your tickets by using promo code WHAM, that's WAM, and I hope to see you there. Also, check out our newsletter, as we are getting demonetized and censored and all that. We don't know what comes next, so we have an email, worldalternativemedia@gmail.com. Send us an email with subject line YES, YES, and we will include you in the newsletter, where we will continuously keep you updated. So until next time, thanks for watching, everyone. This is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change.
I'm sure you have already changed people's minds in your young age because you're involved, and I like that.
Bye.